2026 will mark a major turning point for the finances of Brazilian business owners.
For the first time in decades, the distribution of profits and dividends will be taxed, and ignoring this could be costly. But the good news is that with the right planning and strategies, it's possible to significantly reduce the impact of this new rule. I'm going to show you now, step by step, what you can start doing as early as 2025 to protect your company's cash flow and avoid unpleasant surprises. If your company has accumulated profits from previous years or from 2025, now is the time to act. Approve the payment of these amounts by December 31st, 2025, through a shareholders' meeting or an equivalent document. And they will remain tax-exempt even if the payment is made in the coming years. Also include profit reserves, if any, and clear them out. The cash before the new 10% tax comes into effect. But pay attention. Follow the legal requirements so you don't distribute amounts that don't exist on the balance sheet. In addition, it's important to simulate how much tax you would pay under the new rule. Also assess the impact of the minimum tax if you have other sources of income. With this information, define your strategies. It might be better to change the way you withdraw funds either through payroll, pro-labor, or interest on equity, JCP, or even reconsider the company's tax regime. In many cases, the actual profit regime or even the Simples National may be more advantageous, depending on the margins and the new taxation on dividends. If before a symbolic pro-labor was enough, now it's time to recalibrate. Starting in 2026, salaries up to 5,000 reais per month will be exempt from income tax, and up to around 7,500 reais will have a partial discount. Increasing the pro-labor can reduce the amount of profits subject to the 10% tax and still ensure social security benefits. But be careful. Above the exempt bracket, income tax reaches 27.5%. The key is to find the ideal balance for your business. JCP can be a powerful alternative. It reduces the company's taxable profit, and even with the income tax of 15% at source, it can represent significant savings. For example, by paying 100,000 reais in JCP, the company can save 34,000 reais in corporate taxes. In 2026, even with dividends taxed at 10%, JCP remains advantageous, especially under the actual profit regime. Splitting dividends into smaller installments may avoid monthly withholding, but it doesn't fool the tax authorities. In the 2027 tax return, all income will be added together. And if it exceeds 600,000 reais, the minimum tax will be charged regardless. Plan with an annual perspective. It might be worthwhile to split profits among family members or use a holding company to stagger distributions over the years. The loopholes have shrunk. The key now is strategic planning and professional guidance. The truth is that dividend taxation is going to change the game. And those who prepare now will be far steps ahead in 2026. Here at CLM Controller, we are already working side by side with our clients to face this change strategically. With over 40 years of experience in accounting, taxation, and business planning, we help your company reduce its tax burden, protect profits, and keep operations efficient and profitable in this new scenario. The time to act is now. Plan with us and be ready. Ready for 2026.